Welcome to part 3 of this presentation, the planning and details of a passive income portfolio. In this section, I will talk about 3 or 4 things. One is the factors to look at when you want to evaluate the quality of EEI investments. EEI stands for Enhanced Equity Income. I will also discuss how to map ETFs to different market patterns. I will walk you through how I expect the ETFs in my portfolio to behave when markets are rising rapidly, staying even, treading water, so to speak, or moving downwards. So you'll get a sense for that. Third, I will map the ETFs vis-a-vis the S&P 500, which is my benchmark. And lastly, I will talk about things to look at when you're building a portfolio, the various types of things that you should think about. Let's look at the considerations for quality when evaluating enhanced equity income investments. These are at a minimum the things I look for when I'm considering adding an ETF to a portfolio or determining positioning size for an existing ETF. So if the ETF is a dividend growth one, and as a reminder, the only one that I own is SCHD, the thing to look at is have the dividends grown over the years. So in the case of SCHD, they look at companies with a 10-year history of dividends, but they look at the most recent 5-year dividend growth rate as one of the 4 quality factors. So that's an example of looking at dividend growth. And in addition, if the ETF considers other factors called quality factors, SCHD looks at 4 and creates a composite score of the 4. And this was addressed in detail in my first presentation. So much the better. The note is dividend growth is a reasonable proxy for quality, right? And emphasis on reasonable. The longer the period, the better. If you can sustain 25 years of dividend growth, it certainly shows a stronger business model than a 10-year dividend growth, all things being equal. But it's not as simple as that, right? Because what happens if you're catching Microsoft early on versus Leggett and Platt at 25 years? Microsoft certainly would have been a better investment choice. So it's not a mechanical decision, but I'm just giving you broad consideration. So dividend growth, that's what I look at. In terms of the ETFs that are covered call based, all the rest of the factors are covered or addressed. One is notional value, which is what percentage of the portfolio have the calls been sold on. Obviously, the higher the percentage, the lower the chance of participating in capital gains. So all things being equal, the less the percentage of the portfolio in play, meaning on which calls have been sold, so much the better. The moneyness of the call, how much out of the money are the calls sold for? The further out of the market, the better. Now, the reason firms don't want to sell way out of the money calls because you get very little premium and they can't give high yield, and therefore they can't attract investors. So it's a fine threading of the needle that these guys have to do is sell out of the money, but not too far out as to have too low a yield, and not too far down so that you don't participate in the capital gains. So I typically want to look for it. It depends on the duration. If it's a laddered call being sold 2, 4, 6 weeks out, I'm wanting at least 2 to 5%, 1 to 4% out of the money. If it's a weekly or daily call, then a smaller percentage, as long as it's out of the money. At the money call, ETFs are, in my view, a very sure way to have net asset value degradation. So I am very careful of very high yields And even out of the money covered call ETFs that I own, which gave very high dividend, I watched them like a hawk. The next consideration is the duration of the call. In my view, the shorter the duration, the better. And the reason for this is that markets move in spurts and you don't want most of the gains given away. So again, all things being equal, I would prefer daily calls over weekly, weekly over monthly, and laddered ones where there are ETFs that will sell 2 weeks, 4 weeks, 6 weeks ladders is probably better than purely selling 1 month out. The next thing to consider is cash settled. As far as I know, all the ETFs that I own settle for cash their options. And the key reason for this is that I do not want the underlying asset to being sold and then having to be rebought at the higher price. So if the trade goes against you, the trade goes against you, but at least you own the asset. The next thing to watch is net asset value degradation. There's no point in getting 12% yield and simply having net asset value degradation. You're just eating into your principal. You're selling the doors and windows of the house that you own simply to live on. It's not sustainable. So it's very important to understand that while all covered call strategies will underperform the underlying index, and the reason for this is that gains are capped. You have given away the right to gains above a certain level, but losses are not, right? So in terms of net asset value degradation, there are a couple of things. One is out of the money calls. The second is call spreads. With call spreads, you get to participate in gains above the call that you bought. So examples of call spreads are SPYT, SPYT, and QQQT, and why I like them, right? So things I look at is the 52-week spread for the ETF. And if it's very narrow, like in the case of SWAL, I like it because it's giving the yield and it's a very narrow spread, a 52-week spread. That means the value is very consistent. Or like in the case of QDPL, where the 52-week spread is high and wide, it's because it's moving in tandem with the underlying index, in that particular case, the S&P 500. So it's not like one rule fits all, but you have to understand how to use 52-week spreads depending on the type of strategy. And I gave you two. In the case of SWAL, I want the 52-week spread to be narrow. In the case of QDPL or FEPI, I want the 52-week spread to be high. Total return obviously is what the game is all about. There's no strategy worth it if total return is not part of the picture. I'll say probably for the 99th time that this strategy will yield lower total return in the long term when compared to the S&P 500, but that doesn't mean that I'm not willing to consider total return or ignore total return. I'm willing to have a gap of 100, 150, 200 basis points in terms of annualized returns over the long term. And so the way to do it is to compare the total return of the ETF against the S&P 500. And I do this regularly just to see how things are working. The yield is obviously an important consideration, and it's quite frankly the focus of enhanced equity income investing. Too much is a warning sign and likely unsustainable. So anything once you start getting above 10 to 12%, I get very nervous, skeptical, suspicious, those kind of things. And I watch it. I do own ETFs that are yielding higher than that, but I own them because there's no net asset value degradation. The next consideration is expense ratio. Expense is a gravitational force, right? It's like running a race. The higher the expense, the more the weight of the rocks on the rucksack on your back compared to your opponent. So even if you're a very good performer, in the long run, the extra weight that you're carrying will detract from your performance. So all things being equal, low fees are better than higher fees. You must understand the fee structure. And there are clearly ones that I own where I feel very uncomfortable about the fee structure. They're a bit too high in my view. But you kind of hold your nose sometimes and buy it based on the quality of the strategy that you're buying. Tax efficiency. In the good old days when I started investing, when dinosaurs roamed the earth, we only bought dividend companies and worried about qualified dividends. Now with these much more sophisticated, that doesn't mean necessarily complex, but much more sophisticated products, especially the covered call related and dividend future related ETFs, you have to look at ordinary income, obviously capital gains, and then non-destructive return of capital. So I do look at it, and I do make decisions on whether to own an ETF in a tax deferred account versus a taxable account. But it doesn't, the tax factor is not a consideration in whether to buy an ETF or not. It's just a consideration in where do I keep it, what kind of an account, tax deferred or taxable. And the last significant consideration, quality consideration, is the brand of the ETF provider and the size of the ETF. So the brand is important because ultimately what you want is to know is the ETF provider playing the long game? And what happens is, quite frankly, you can make out. You can make out when you see the interviews and how they come across. And you have to be a reasonably good judge of character and have a business sense for what it is that they're really saying. If they are, they have very risky products, they're selling at the money calls and selling what I would call excitement, beware. If they are, trying to show balance, and if they explain things like, we're doing spreads and we're only wanting to get 12%, we want our customers to get a reasonable return, that's music to my ears, right? I'm not looking for someone who is a rah salesperson. So those are the things that I look for in the brand. And brand and assets under management go hand in hand, right? The better the product, maybe the slower the start because investors tend to get distracted by excitement and may or may not be the best judges of quality. But in the long run, quality always outs. And so like QQQT, which is a very new ETF that came out, is from the same people that gave you SPYT, and that's the call spread ETF. I had no problems being one of the first buyers in the first week because I knew the brand, I knew the strategy, and even though there was a significant spread when I bought it, meaning I probably paid a few cents extra per share when I purchased it, since it's a long-term purchase, I'll probably do just fine. I'll now walk you through how I map my ETFs to different market patterns. And by market patterns, I mean steady markets, declining markets, rising markets. So this is steady markets, treading water, not moving up or down. I expect all my ETFs to do better than the index, except for SCHD. And the reason for that is that every one of these ETFs is selling calls, and so I'm getting income even though the underlying assets are not moving, including the S&P 500. So this is where there should be outperformance on the part of my portfolio. If the markets are declining, I expect all the ETFs to again do better except for SCHD because SCHD is not generating any extra income, whereas all the ETFs are. So this is the second scenario in which I expect outperformance. If the markets are rising gradually, and by gradually I'm talking less than 1% a month, many of my ETFs should capture most of the gains and all the others will participate some. So SCHD will have full participation because there's no cap on growth, there's no covered call being sold. QDPL should do extremely well because 88% of it moves with the market. JEPI and JEPQ should do well because of both. Notionally, they don't sell calls on 100% of the portfolios, and there's enough of a gap between market price and strike price in the way they have structured their ELNs, so that should be good. Devo, for the same reasons, lower than 100% on notional and out of the money calls. So they should capture quite a significant amount of the gains, and all the others should participate some. So that's not bad. So in all three scenarios so far, my portfolio should either outperform or kind of match. Where it will rather seriously underperform is when markets rise rapidly. Unfortunately, for me and for the strategy and for how the world works, this is how gains come in the market. They come in spurts, which I explained previously. And this is why no matter how well I construct this portfolio, I'm going to have total return underperformance. And the reason is that when you have one of those 10 days that matter over 20 years, the gains might be 3, 4, 5% in the course of a day. In that particular case, I expect SCHD to do just fine because there's again no cap on the growth of it. Devo, let's move that to the side just for a second. QDPL, because of the 88% participation of the S&P 500, SPYT and QQQT should get quite a bit of the gain because they have call spreads. So I get to participate in the gains above a certain level. So that's not bad. All the others likely will underperform, and that underperformance will have long-term implications because once you've missed the 2 to 3 to 4% in that day, you've missed it forever. In terms of the stock style, I own growth type companies, primarily in S&P 500 and NASDAQ, and I own a lot of non-growth companies like an SCHD and large portions of the S&P 500. Devo is quality, as is a CHY, meaning they're non-growth. They're not the Nvidias of the world. So I'm marking my style as large cap blend, neither only on value or on growth. Since markets mostly move up and do so in spurts, like I just described, this kind of a strategy, an enhanced equity income strategy, will almost certainly underperform in total returns. But I will have lower volatility, and I have demonstrated that with real data earlier in this presentation. And I accept this trade-off because it is relevant for the phase that I'm in. I'm in the second stage as an investor, which is wealth retention, income generation. Those are the two primary considerations, not trying to grow wealth. I again expect underperformance to be in the 100 to 200 basis points per year. Okay. So I think that's pretty much it for mapping ETFs to market patterns. I'll now walk you through my current portfolio, all the large positions. Please remember that my next presentation, the design and details of an EEI portfolio, will address each of the holdings I'm talking about in considerably more detail with a lot more of the design considerations. It's a presentation by itself, but I think it's important that you get a good sense for what an EEI portfolio looks like. One of the most important points is that the S&P 500 is my benchmark. So no matter what I own, I want to know how it does relative to the S&P 500. And it's a reminder for probably the 54th time, and boringly so, higher income and lower volatility are my primary objectives at this stage of investing. I'm willing to take a slight drag when compared to the S&P 500. Not a huge one, but I've accepted and internalized that my portfolio cannot give the same total return as the S&P 500. So S&P 500 is the centerpiece. So the holdings which are not in sync with the index are these four: SCHD, pure dividend growth, and good size. Devo is an ETF, is actively managed, run by a pretty good company called Amplify. They only own about 25 companies, high quality companies, don't give much of a yield, give a yield of about 4.5%. but have done a very good job in terms of total return. SCHY, which is the international version of SCHD, and as a reminder, owns 100 companies in developed markets only that meet the criteria that I explained previously about how SCHD works. JEPI is one of the largest and probably one of the earlier covered call ETFs out there. It's from JP Morgan, good brand. I really like Hamilton Reiner, the manager who's kind of oversees the fund. I've seen his interviews, and I'm a big believer that ultimately, even in very, very large organizations, people do matter. JEPI, many people think it moves in tandem with the S&P 500. I've owned it for a while now, and nothing could be further from the truth. It only contains about 100 companies. Secondly, there's no concentration. It's the top holding is about 1.6%, and the next subsequent holdings 1%. There's a fair amount of turnover, and it depends on the interview and the literature, but sometimes they have emphasized low volatility price and low volatility earnings to be a key consideration. And sometimes they just talk about strong fundamentals. Just to give you an idea of the top 5 holdings, all of them around 1.5, 1.6%. The top holdings today on the 28th of June were Amazon, Microsoft, Meta, Train, and Progressive, the insurance company. So these are my base. They are very diversified, and they are, in my view, the anti-S&P 500, even though obviously almost all the holdings are from within the S&P 500. It's the emphasis and the difference in the different percentages that make it the anti-S&P 500. So essentially, these are stodgy quality companies, and the check signs are large holdings. So SCHD is my single largest holding. It's almost twice the size of any of my other holdings, so that's why it's got a double check. JEPI is something that I hold quite a bit of, somewhere in the 8 to 11% range. In addition, I have 2 other holdings, both from Simplify, which is another brand that I like. These guys do a very good job with options type trading. SWAL is almost 1%, and I don't intend to add too much to it, but it's a very good 1% of my portfolio. And essentially what they do is it's a bet on mean reversion of the wicks. So when volatility goes up due to market fears, etc., they go short volatility, and just in case volatility stays high for extended periods of time, they buy kind of a way out of the money call to cover the tail risk, if you will. It generates about 15% in returns, and there's very little net asset value appreciation, but for the length of time that I've had it, and it's not a short duration, I think I've had it for quite a while, maybe over a year, the 15% has been consistent. So 15% without net asset value degradation is giving me above market returns. I am a big believer that assets must produce income. Therefore, I don't like things that are stores of value like gold and so on. Recently, Lynn Alden, who was interviewed on the Compound, which is a very good podcast, she made a convincing case for Bitcoin. There were 2 things in her case. One was that it's capped. Bitcoin is capped at about 21 million units, and it gets halved every 4 years. And secondly, she said, don't look at everything through the prism of the US investor, because we have many ways to store our money in other countries, and she used Egypt and so on and so forth, where currencies depreciate They don't trust institutions, etc. When they do work, when people do work, especially when they're doing transactions across countries and so on and so forth, Bitcoin is the medium of the transaction. So her pitch was that unlike gold and other things, Bitcoin is actually providing value. So I've decided to invest no more than 1%. So I'm building it up. And Maxi has a product where they own Bitcoin um, via futures, and they generate income by selling option spreads on various ETFs and so on. I have to do a lot more digging to understand the mechanics, but I have a fairly high degree of confidence on Simplify based on my experience with them on with this fall. Somewhat in sync with the index are the next few investments that I have. QDPL, which is from Pacer. This is one of the ones I like the most out of these five because 88% of the assets are directly held in the S&P 500 index companies. And then 12% they sell, they buy futures in dividend futures 3 years out. It's a little bit of an inefficient market based on the literature that they have referenced, and that inefficiency accrues to the buyer of the dividend future. So QDPL actually stands for quadruple. So they're trying to kind of get S&P 500 type returns, but with 4 times the income. So that's one that I really like. iSpy is from ProShares. They sell calls daily. So that's a different strategy. Again, out of the money calls. SPYI is from NEOS, NEOS. It's a company that I respect. They're new, and I've seen interviews with Garrett Paolela. I hope I'm pronouncing it correctly. And again, it's out of the money calls. They use laddering, and their notional is always less than 100%, meaning they don't put the entire portfolio in play. So I'm building my position there. SPYT is probably my second favorite after QDPL, and it's from Defiance, and the guy there that I respect is a guy called Jay Pestrichelli, and looks like a very experienced person. And what SPYT does is it's a call spread, and I love the strategy because what they're doing is uh, selling a call just above market price and then buying a call a bit higher than that. So there's a net income that's generated that they spin off, and you get to participate on those days when markets have spurts. And if you remember from my previous slide, um, that markets move up, over 20 years, 10, 20 days where it moves up in spurts make up all the difference. So that's the reason I like SPYT and QDPL. XDTE is from a fairly new company called Roundhill. I uh, like Dave Mazza, who's the CEO now. Um, and I've seen his interviews and so on and so forth. And again, it's a daily strategy, slightly different than ISPY. So I'm just hedging there. And these are the check marks tell you the ones where I'm building up pretty good size positions. And by good size, I'm talking somewhere in the range of 2.5, 5, 7.5, even 10%. Like QDPL, for example, will end up being a 10% holding. Um, then I have NASDAQ 100 based ETFs, and many of them are just the NASDAQ versions, the NASDAQ 100 versions from the same companies compared to the S&P 500 ones. So where you have SPYI, you have QQQI, the same strategy but on a different index. You have QDTE, which is the NASDAQ version of XDTE, daily options. IQQQ is the daily version of SPY, and QQQT is the call spread version of SPYT on the NASDAQ 100. Um, JEPQ is worth talking about. JEPQ is again from JP Morgan, and it's their strategy based on the NASDAQ 100. The enormous difference between JEPQ and JEPI is that JEPI only contains 100 companies out of the S&P 500. JEPQ actually has about 90 plus. And when you look at the top holdings, they seem like a mirror image of the NASDAQ 100. So you're definitely getting a play on the NASDAQ 100. JEPQ is the single most profitable holding that I had. I bought it when it first came out, and I saw the interview with Hamilton Reiner, kept adding to it because it worked, and it on my cost is probably yield on cost is probably around 12%, and the net asset value has increased by about 33%. Let's see. FEPI is an even more kind of concentrated, more growthier, more focused, more volatile holding. It's based on a very unique tech index from a company called Solactive, a German company of all places. And FEPI holds 15 technology companies. 8 of them are fixed. 7 of them are the next 7 largest market cap. So you've got all the, the Amazon, the Nvidia, the Netflix, that kind of thing. And they sell calls directly, out of the money calls, directly on the underlying holdings, and they cash settle the options so that they don't keep having to buy the companies over and over again. It's probably in the 2.5% to 5% range in my portfolio, and very quite tax efficient. So the check marks tell you where I'm going to be building up large positions. The X's tell you the tax inefficient ones. So those are the ones I only try to hold in IRA accounts: JEPQ, JEPI, SWAL, and MAXI. All the others either are providing a very high return of capital, like QDPL, SPYT, etc., or qualified dividends, as in the case of SCHD and SC. I'm constantly learning. I try to spend about 2-3 hours a day keeping up with new products, news, the business world, the economic world, and so on. So these are the questions, the open questions I'm struggling with in terms of investments. One, and this is what I'm going to focus on studying, learning more about. One is I don't fully understand the long-term impact of owning assets synthetically. And by synthetically, what happens is they buy a call and a put at the same strike price, and that's how they own it. And so I don't understand what the trade-off is. Is it better to actually own the underlying asset, let's say SPY, versus buying call and put options on a recurring basis? And when you buy it synthetically, you obviously have a ton of cash left over. So that cash generates interest income because it can be invested. Whereas when you hold the underlying asset, your capital is tied up, and what you're getting is the dividends being thrown off from the S&P 500 or the NASDAQ 100, which is very low. So I don't understand kind of the pros and cons of both the approaches, and especially I don't understand them statistically. What happens in markets which over the long term increase in value? So that's one thing I'm going to study. The second thing is most of my investments, as you saw, are based on either quality factors, dividend growth like SCHD, or S&P 500, or the NASDAQ 100. And yes, I do have some alternatives based on Bitcoin like Maxi, based on going short volatility, as in the case of SWAL. But I don't really have any mid cap or small cap. There is an ETF called IWMY, which is based on the Russell 2000, which is small cap. I just need to understand that index better and see, how it's constituted, how concentrated it is. Is it actually adding to diversification in a value adding way. When I looked at the holdings, I was not very impressed by the quality of the companies in the top 10, top 15, but I just have to do more research. So that's what I intend to focus on. And as I learn more, I will make modifications and in updated presentations, share my modified portfolio as appropriate. Here is how I would go about building an enhanced equity income portfolio, the kinds of things I would look at and consider an approach, if you will. One is before you start spending money willy-nilly, read books, listen to experienced investors, including presentations like this one. And there are two things that you want to do. The action is obviously to develop and document your strategy. You must write it down, right? In my case, I have a documented strategy, which, very briefly is that I want enhanced income investments, ETF products primarily, and they must be index based. So when you document a strategy, your chances of staying with it are higher. And the reason you know you have a good strategy, a really good strategy, is one that you can stick with. If you buy investments and you are constantly worried and buying and selling, you don't have a strategy. You have something else. And because it's an EEI portfolio, make sure that you internalize, which is a fancy way of saying that you accept the trade-off between income and returns. If you get higher income, like I do, higher than the S&P 500 and the NASDAQ 100, I'm going to have lower total returns. If I don't accept it, I'm trying to achieve something that is impossible. So the mindset that accompanies this action of documenting a strategy is, in addition to accepting lower than market returns, the benefit is you'll get lower volatility. Second is you must diversify. No matter how good I think QDPL is, or SCHD is, or SPYT is, I cannot put more than a certain percentage into those investments. That's just how diversification works. And you know you're diversified when not everything is working all the time. A well-diversified portfolio has some aspects of it working really, really well and others not. That's literally how diversification works. And lastly, in terms of the mindset, if you quit buying and selling all the time, you're actually allowing compounding to occur. And in my very first presentation, building a nestegg, I demonstrated how compounding works, how $1 becomes 16 and then 32. So when you interrupt compounding, you've wasted a tremendous amount of energy for no reason. So in terms of planning your portfolio, here are some of the things I would think about. One is position sizing. How large will your largest position be? How large will each position be? So there's a reason that I will not own more than 1% of SVOL, 1% of Maxi, which is the only Bitcoin position I have, no more than 1% into the single company ETFs from Curve, like the ones based on Google and Amazon. So there's a logic behind it. I'm not willing to take too much risk, but I don't mind owning 15% of my entire portfolio in SCHD or 10 to 12% in QDPL because they're broad-based, index-based ETFs. And typically, when I decide to invest, I'll first build a monitoring position. So I'll spend $500, $1,000, $2,500, $5,000, depending on the situation. And then I just watch and learn. Nothing focuses the mind than having real assets in play, real money at stake. And in about 6 to 8%, 6 to 8 out of 10 times, I find that the investment is not worth it. There are things that I have not thought through. So only after learning do I take the next step, which is either to get out of it or to build a larger stake. I always dollar cost average into positions. I don't take a long period, but if I have $25,000, I'll probably put it to work over 2 to 3 months. The sooner I put it to work, the better. But to mitigate regret, I'll dollar cost average. Even though the data shows that buying when you have the cash is actually statistically better, for me psychologically, dollar cost averaging over brief periods of time is works better for me. And I just don't like selling. If something is working, what exactly is the point of selling? So the only reason I sell is when I'm changing strategy. And over the last 3 years, I've sold 90% of my individual dividend growth stocks to buy these higher income producing, more diversified covered call ETFs. So their selling made sense. And it, by my calculations, my moves paid for themselves in that same calendar year. So even after paying capital gains tax, I still came out ahead, and then came out ahead on a virtual long-term basis. Please remember that behaviors matter as much, if not more, than the investments themselves. So what happens is we try to get investment decisions precise, right? We'll only own 6.734% of this, and I'm doing it based on these projections and so on. What you have to do with position sizing, with your portfolio, your capital allocation decisions, is you have to get them directionally correct. Does it really matter whether, I'm just making it up. Let's say you were not doing an EEI approach. Let's say you were doing a 60-40 portfolio, 60% equities, 40% bonds. Does it really matter whether it's 60-40 versus 55-45 or 70-30? In the long run, not really. Directionally, once you decided to go into equities and bonds, you really can't go wrong if you are in any of these ranges. So the behaviors that the gurus like Buffett and others would warn us against is constantly tweaking, constantly buying and selling, constantly thinking that there's a better strategy out there. And usually that happens when you have rushed into your strategy. Monitor performance. Don't live in an artificial world. Uh, Make sure that you understand how you're doing vis-a-vis the S&P 500, which is the benchmark for me, and take corrective actions, but don't rush to it. Just because you've had a bad year doesn't mean you have to change your strategy. But if your strategy is not working over 3, 5, 7 years, like for example, once I realized that the dividend growth companies that I own, even though they were well researched and they were very high quality companies, the gap was rather high versus the S&P 500, and I figured out through calculation that I could get much higher income through these covered call ETFs and still have about the same 100% 100 to 200 basis point gap. So it was a no-brainer decision for me to move from one approach to the other over time. Not lastly, but the next point is, please remember that the purpose for you to set assets aside and have money is so that it gives you comfort, that it gives you the ability to sleep soundly at night. And a sure way to not sleep soundly at night is to do things like not diversify, make big decisions rashly and quickly, not calmly and thoughtfully. So make sure that money goes to work with you in addition to actually giving you options, also gives you peace of mind. Morgan Housel has a wonderful saying called risk is what's left over when you think you have thought of everything. And diversification is the answer to when you don't know everything. And there's not one of us who is alive who knows everything. So you can diversify too much to where your portfolio literally has no performance, but you can diversify within reason and mitigate risk. And it's important to understand that when it comes to equity investing, and remember my portfolio is pretty much 100% equity, volatility is not risk. Volatility is simply short-term movements in market prices in a market that over the long run goes up. So dealing with the emotions from volatility is the price you pay to get equity-like returns, and equity-like returns are the highest of any asset class. So volatility, do not confuse volatility with risk. Risk is permanent loss of capital, capital that you will never get back. The risk for me with owning IBM was owning it for 8 years, getting dividends, and then end up losing 25 grand of my capital. That was risk. So these are the things I would look at in building a EI portfolio. So as we come towards the end of this presentation, I would like to remind you of a couple of things. One is success is the sum of small efforts, practiced day in and day out. You want to get healthier, you eat a little bit better tomorrow and exercise more tomorrow than you did today, or exercise better tomorrow than you did today. And I encourage you to start your investing journey. If you have started it, do course corrections if you have to. But regardless, do plan for your financial future. And lastly, I would like to thank Gayatri, my wife, for being my partner in every endeavor, including this one. I couldn't have done it without her support, her technology knowledge, her relentless feedback, and for being a vociferous champion of my efforts. So in closing, I would like to say that I'm sharing everything I know because I've learned everything I know from others. And I'm paying it forward. I have the time, the flexibility to do so, and I'm glad to be able to do it. Secondly, no matter how much you get impressed by anybody else's thoughts, always do your own due diligence. Use information like I shared in this presentation and the previous one and in subsequent ones for triangulation, for building your own strategy, your own framework. Don't 100% copy anybody. There are no heroes. There are heroic qualities to be emulated, but nobody is perfect. Nobody is doing this 100% correctly. This is my second video. Please, if you have made it this far, provide any feedback on future topics and on this video so that I can do a better job in the future. And I have lots of topics that I want to cover in subsequent videos. I intend to cover every single ETF that I do own. I also intend to cover ETFs that I have evaluated and do not own so that people understand why I don't own them. I want to cover the indexes like the Standard & Poor 500, the NASDAQ 100, the one that SCHD is based on, the Dow Jones Dividend 100, my risk management framework. There are many such topics that I would like to cover in subsequent videos, and I intend to put one out every week. So thank you for listening. Goodbye and good luck.